The stock has been on a wild ride. Is your company fairly valued?
Yes, as you know, we deliver the best generative AI platform in the world, especially in terms of time to market. Whenever new technology is available, we are able to deliver new product to the market. And we deliver product in a system level or rack scale. We call a rack plug and play. When customers receive our rack, they are ready to be online, just plugging two cables, data cable and a power cable, and then they are ready to be online. So customers like our good quality, time to market, and ready to run advantage.
Charles, there's clearly a lot of excitement in the market that whatever is happening in AI infrastructure investment, you are a core beneficiary. But one of the questions that Caroline and I get for you consistently is, what is it that Supermicro does that's any different from your biggest competitors, names like Dell, HPE?
Very good question. Yes, we have something special. First, we are a very lucky company. Since 30 years ago, I founded a company, Supermicro. We use building block solution, modularized design, to build our server, to build our total solution. And the building block solution enables us to design product more efficiently, with better quality, better inventory leverage, and better service efficiency. That's why we are able to deliver new technology, time to market, earlier than others. And plus our true global company. We have an engineer working in San Jose, Bay Area, and also a big team in Taiwan. So with two teams, Asia and USA, so we are able to design product more efficiently than others, basically.
An unexpected wave of strategic maneuvers in the stock market has captured everyone's attention this quarter. And now analysts and big money investors are continuing the train of surprises that the stock market is chock full of by completely dropping faith in Nvidia and stoking the flames of another completely different tech company, predicting that it will soar to heights that will put Nvidia to shame. And it all starts with the tale of Nvidia and Supermicro Computer, which are suddenly central to some perplexing hedge fund decisions. Industry giants like Cliff Asness, Ken Griffin, Israel Englander, and David Shaw, each renowned for their superior insight and sharp market instincts, have made the just-discussed head-turning adjustments to their portfolios that will leave your jaws on the floor. Nearly simultaneously, they trimmed their positions in Nvidia while boosting their stakes in Supermicro. What might these Wall Street titans foresee in the tech landscape? Why did they suddenly lose all hope in the tech behemoth known as Nvidia? A lot of unanswered and curious questions to dissect and understand. So let us not waste any more time and let's dive deeper to unravel the motive behind the shifting of these analysts' colossal funds. Welcome back, everyone, to Investocracy.
And I'm interested, Charles, the scale of the market size here, the total addressable market. How big can it be? How big a chunk of the pie are you going to get?
Oh, yeah, that's another advantage we have. We design product in Bay Area and manufacture in Bay Area and global as well. So, we work with customer from design stage, validation stage, until we ship the product to customer, make them plug and play. And yes, we have huge capacity ready now. In Silicon Valley alone, we are able to build 4,000 rack per month, or equal to about 15,000 systems per month. And in Asia, in Europe, we also have a production capability there. So basically, we are able to build enough server for our customer. But now, as you know, the chip shortage. So once we have a more supply from the chip company like Nvidia, then we can ship more to customer.
For years, Nvidia has stood unshaken as the colossus of the AI boom, much like the indomitable Goliath in the tech world. Nvidia has a commanding market share of over 90% in data center GPUs and dominantly holds more than 70% of AI chip sales. In the omnipresent world of AI hardware and software, the company's name has almost become synonymous with innovation and power. The NVIDIA AI Foundry platform supports developing custom generative AI models, while the NVIDIA AI Enterprise platform drives AI applications across various industries, from robotics to logistics optimization. But here's where things get as quirky as a stock market meme. In the second quarter, notable hedge fund managers made significant moves. Cliff Asness of AQR Capital Management sold 1.3 million shares of Nvidia, trimming his stake by 8%. Israel Englander of Millennium Management also pared back his Nvidia position by 5%, shedding 676,242 shares. But before we go any further, if you want to keep up with Nvidia's latest updates and keep up with the stock market's latest news, you can follow our Twitter account. We post multiple times daily about the biggest changes and catalysts in the market, so click the follow button if you don't want to miss the newest market updates.
Charles, do you have a number, a dollar value for the total addressable market that you see for your company in the context of an AI infrastructure build-out?
We always facing to a big back order. So the market size is growing. Right? As you know, AI boom basically just start. We believe the market have a big room to grow, and lots of industry leaders have the same feeling. So as of today, our production capacity can support our revenue up to $25 billion, for example. But we need more chip, like what I just mentioned. So again, the market continue to grow, and we continue to get market share because of better product, because of rack scale, plug and play. So we are continuing growing our production capacity in United States and globally as well.
Even more dramatically, Ken Griffin of Citadel Advisors slashed his Nvidia holdings by almost 79%, selling 9.2 million shares. David Shaw of D.E. Shaw and Company also joined the chorus by reducing his Nvidia stake by 52%, offloading 12.1 million shares. While it seems like these titans might be moving away from Nvidia, not so fast. It's not that they are abandoning Nvidia altogether, as they still maintain substantial positions there. Instead, they're diversifying and placing substantial bets on a rising star, Supermicro Computer. Here's a quick chuckle for you. Why don't stock market investors trade horses? Too much of a gamble? In a way, our hedge fund managers are making a safer bet with Supermicro. Supermicro is somewhat of an unsung hero in high-performance computing platforms, known for its innovative AI servers. The beauty of Supermicro lies in its nimble manufacturing capabilities and modular approach to product development. This flexibility means Supermicro can typically deploy new technologies faster than its competitors, often 2 to 6 months earlier. Such agility is a goldmine for staying ahead in the AI server market. Financial data supports this pivot too. Supermicro reported an impressive 144% increase in sales to $5.3 billion in its fiscal 2024 fourth quarter, thanks to strong AI infrastructure demand. However, it wasn't smooth sailing all the way. Their gross profit margin took a hit, causing a narrower-than-expected earnings increase of 78%. Adding to their woes, a report by Hindenburg Research dropped a bombshell, accusing Supermicro of various financial misdeeds. As a result, the stock plunged by 24%, creating a perfect storm of uncertainty until only recently, where the stock picked up steam once again like usual because it is just that good. So don't write off Supermicro just yet. But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
All right, I got something to say about this mini semiconductor bear market. For the last couple months, Wall Street learned to love to hate the chip stocks. The whole group's down almost 22% from its highs on July 11th, as represented by the SMH. That's a key semiconductor ETF. Many individual names have come down even harder from their highs. Intel is off a staggering 63%. Micron down 45%. AMD's lost almost 40%, just to name the most egregious examples. Now, some of that's simply because the chip stocks got overheated. While the SMH may be down 22% from its highs, it's still up over 25% year-to-date, comfortably outperforming the SP 500. They rallied too far, too fast, and need to come in. On top of that, you've got these pervasive worries about AI spend. For the past few months, we've been hearing that the companies spending fortunes on AI infrastructure simply aren't seeing enough of a return yet, and they might start dialing back their investment at some point. Now, I don't see much evidence of this, though. The bears will point to Nvidia's failure to report a spectacular revenue beat, but that only happened because their new AI chip Blackwell got delayed. They are having trouble producing it at scale. That's totally reasonable. But they've basically solved the problem now. Supply problem, not a demand problem. Demand is off the charts. Finally, you've got people worrying that we're headed into a recession. which could hit all kinds of tech hardware and trickle down to the semis. But the Fed's about to cut interest rates next week. And an easing cycle will bolster the economy. Buy. Plus, this very evening, we got a startlingly a good report from Oracle. And a lot of the good news came in concert with data centers for AI. Hey, not bad. In the end, I think the chip stocks have sold off way too hard. Every reason we had to like this group earlier this year remains intact. The AI spending boom is very real. There's a ton of money being spent to build out the infrastructure, as we heard from Oracle this evening. More important, there's more to chips than AI. For the past couple of quarters, we've been exiting a period of oversupply in the semiconductor market, and we're now finally seeing some excellent sales growth. Yes, we're past the point of equilibrium. We're going up. The semis just had their 4th straight months of sequential sales growth in July. Do you really want to abandon this group just as we're coming out of a supply glut?
Wall Street analyst Samik Chatterjee from J.P. Morgan remains steadfast in his support, believing the allegations to be largely bereft of detailed wrongdoing. He has maintained a bullish price target of $950 per share, highlighting a potential 130% upside from its current levels. Moreover, with Wall Street forecasting Supermicro's earnings to grow annually at 46% over the next 3 years, it's hard to ignore the value it presents. A current valuation of 21 times earnings makes it look especially appealing, particularly when its price-to-earnings to growth ratio is a mere 0.46. This is significantly cheaper than its 3-year average of 0.89, presenting a tempting entry point for patient investors. In stock market investments, sometimes it's not just about betting on the champion, but understanding the strategic plays that could translate into exceptional growth. The shift in focus from Nvidia to Supermicro Computer by top hedge fund managers is a decisive nod to the latter's potential amid the AI revolution. Despite temporary setbacks, the long-term outlook for Supermicro seems promising, laden with opportunities for substantial gains. Currently, Supermicro is trading at a fraction of its projected potential, making it a reasonable prospect for those willing to ride the wave of innovation in AI servers. With financial forecasts looking robust and seasoned analysts retaining optimistic price targets, the skeptical drumbeat of market reports could just be the noise before the symphony. What's your take on this intriguing pivot by the hedge fund maestros? Does Supermicro hold the promise they foresee? Let's keep this conversation going and see where this roller coaster ride in the stock market takes us. And finally, if you would like to know what companies like Nvidia and Supermicro have been up to these past few days, go ahead and click on the next video on your screen. See you there.